Hey folks, welcome to a product review at Finominal. Today we're going to look at IQ's Merger Arbitrage ETF that trades under the ticker MNA. Now what's Merger Arbitrage? Merger Arbitrage is a traditional hedge fund strategy that aims to provide uncorrelated returns and diversification benefits. Now, the way Merger Arbitrage fund constructs his portfolio is by going long companies to be about to be acquired and shorting companies that are acquiring them. And that way you have a market neutral portfolio that theoretically is uncorrelated to whatever happens in stock markets. So let's have a look at M&A in terms of what have been the drivers of performance and of risk. And we're going to use our alpha analyzer tool for that and going to run a returns-based factor exposure analysis. Now, what we can see over here is the factor betas over time. And this product has more than a 10-year track record to the major asset classes. Now, what we see effectively is that the exposure to the S&P 500, bonds, the US dollar index, commodities was close to zero, as expected. But be aware, not exactly zero. And if we then look in terms of what have been the major contributors to returns, we see that this unfortunately has been primarily the stock market. Now, it is worth mentioning that this ETF constructs its portfolio by going long the companies to be about to be acquired, but instead of shorting the companies that are acquiring, it is shorting a global equities index. And it might be that this explains that effectively positive beta to the stock market. But what we should be seeing here is, like that the major contributor of the strategy is unexplained, or alpha, i.e. the yellow bars, and not the stock market. And this, of course, kind of indicates that this product does not offer any diversification benefits. But let's evaluate that. And we can use our diversification booster tool for this. And the first thing that we're going to look at is the correlation to the stock market. And as mentioned, the portfolio of a merger arbitrage fund should be constructed beta neutral, meaning it has zero correlation to the stock market. However, what we see over the last close to 15 years, that M&A had a correlation of 0.46 to the stock market, which is way too high for what's supposed to be an uncorrelated strategy. Now, we can actually quite easily simulate in terms of what would have been diversification benefits. And so here we have a portfolio just comprised of the S&P 500. And over the last 14.5 years, this would have generated a Sharpe of 0.8. Quite attractive, but we've been largely in a bull market. Now, if you would have allocated 25% to M&A, your Sharpe ratio actually would have slightly decreased. Stated differently, there were no diversification benefits. And we can dig into that a little bit further by looking at the roller correlation to the S&P 500. And what you see is that in crisis times, i.e. during COVID-19 in 2020 or kind of the bear market in 2022, the correlations of M&A to the stock market spike. And so this is a general feature of the merger arbitrage strategy, that when markets are called, then mergers close. But when stocks crash, then mergers get aborted. And that's effectively when you lose with this type of strategy. Now that's of course problematic because investors need diversification most when stock markets crash, i.e. for example here in 2020. And this product did not provide that. And that of course explains why there is zero diversification benefits from this product. Now that's M&A on a standalone basis, but let's have a quick look how this compares to its peers. Now there's three other products, one from Allshares, First Trust, and ProShares. And we're simply going to first have a look at the performance of those four products. And I think we have, well, about 4 years of track record where all these products have been listed. And what we do see is effectively that MNA has kind of almost performed the worst throughout most of its period. We can also see that it's been more volatile. And if we switch to Sharpe ratios, we can see that MNA has generated much lower Sharpe ratio than, for example, this product from AltShares, ARP, which has a Sharpe of 0.67, or the one from ProShares, which has a Sharpe ratio of 0.48. Now, it is worth mentioning none of these products is particularly cheap. MNA charges 77 basis points, and it's of course perfectly fine to charge 77 basis points or even higher than that if you are providing something unique. But going back to the underlying problem of MNA as well as its peers, except perhaps for the product from First Trust, is that the correlation to stocks are too high. We would expect that almost all of these products should have a correlation of 0, i.e. the dot should be over here and not on the right-hand side. And that, of course, prohibits these strategies from generating diversification benefits. And this kind of concludes our review of IQ's Merger Arbitrage ETF. So Merger Arbitrage, and this applies to private hedge funds as well as these ETFs that try to offer the same strategy, that they're all marketed as offering uncorrelated returns, that they generate diversification benefits. But as mentioned, in crisis times, mergers tend to get aborted or cancelled. And then the correlation of these products tend to spike to the stock market. And what investors were assuming is an uncorrelated fund becomes a correlated one. And so there's just better diversifying strategies out there. Well, hope that helps. Have a nice day.